All right, well, let's go ahead and kick into it, guys. Thanks for joining us today. My name is Hall Martin with 10 Capital, and today we have with us Misha Vasilchikov of ARGO Capital Advisors. Misha, thank you for joining us. I think you're on mute, Misha.
All right, there we are.
Great.
Thank you for having me.
You bet. Thanks. And our title today for the presentation is Learn How to Analyze a Secondary Offering, including Valuations. I get this question a lot from investors out there, especially family office and others looking to engage in the secondary space. Companies are staying private much longer, and so we're seeing companies sell shares to give employees liquidity, and many investors are now engaging at that level rather than the IPO or post-IPO levels. So with that, I'd like to have Misha tell us a little bit about his background and ARGO itself. Misha?
Absolutely. So for those that don't know me, I'm a co-founder and a managing partner at ARGO Capital Advisors. We are a boutique investment banking firm based in New York. Secondaries have been, I'd say, a huge portion of our business, especially over the last, call it 6 to 8 months. Much like sort of the broader audience, this has been an incredible learning experience for me as well. Just seeing what's out there in the market and sort of the opportunities that are available to sort of the broader investor base. ARGO is comprised of 3 partners, so myself and 2 other gentlemen. And we're all based in New York. We're all licensed, so operating through a broker dealer. And yeah, that's sort of the quick overview on ARGO.
Great. Well, we have a set of questions we'll go through here, but like I say, if you guys have questions in the audience, put them in the chat box and we'll work them in as well. So the first question, Misha, is what is the main trend in the secondaries market today?
Yeah, so before I even answer that question, I want to just make a quick distinction here between, call it traditional secondaries, right? Purchase or sale of preferred or common securities in private companies, or PE secondaries, effectively LP interests in funds. Both are sometimes called secondaries, but we as ARGO deal only with traditional secondaries. Firms like Pomona Capital or Collar Capital, amongst many others, focus on transacting in LP/GP interest. And so, to answer your question, in recent years, both traditional and PE secondaries have seen meaningful increases in transactional value as investors start to better understand these markets. By way of reference, private companies have experienced explosive growth over the last decade. Currently, there's over 600 companies who have achieved a unicorn status/valuation of $1 billion or more. And the private company unicorn asset class presently has an aggregate value of just under $2 trillion US. When one looks at the valuation trajectory of companies, it's easy to see that most of the growth takes place before the company goes public, and there's obviously a little bit more risk for investors there. However, if you're focusing on that segment of private companies where they have achieved certain critical scale, both in terms of revenue, funding rounds, and valuation, effectively becoming unicorns, the risk of failure is meaningfully reduced, although not completely eliminated, but there's still room for growth and ability to generate attractive returns. As a result, what we are seeing now is more types of investors that are becoming more open to investing into successfully scaled private companies over and above traditional VCs. More and more are starting to sort of approach us from the family office front, asset managers, pension funds, endowments that are looking to back privates during later stages. This ultimately gives founders and management teams enough financial backing to stay private longer and not worry about the headaches and the challenges and the costs of becoming publicly traded companies, right? For example, Stripe, an Irish-American financial tech company, fintech, did its latest private round at $95 billion valuation. Plaid, another fintech company, is at $13 billion. Tanium, cybersecurity, $9 billion. SpaceX, $46 billion. Impossible Foods, $4 billion. the days when achieving a valuation of a few hundred million and rushing to get listed on the New York Stock Exchange or NASDAQ are long gone. This in turn creates the need among early investors and management teams to turn to firms like ARGO or online platforms such as SharesPost or EquityZen to create market for their secondaries and for those that are seeking liquidity. Think about it this way. Let's say some VC invested $1 million into a startup at a $10 million valuation. When the company hits $1 billion valuation, that 1 million is now worth 100 million. This may have taken 5 years to accomplish, but with everything going on in the private company markets, founders and management teams may choose to stay private to hit $10 billion or more before contemplating an exit or an IPO. This will inevitably take time. VCs will want to sell a portion of their stake for a number of reasons, such as not wanting to have their entire stake be subject to a lockup, some LPs wanting to be out, turning a portion of their unrealized gains into realized ones. And at the same time, there are investors who find this remaining investment profile attractive, giving them the ability to generate multiple returns in a meaningfully de-risked business.
Great. So my next question is, what should an investor look for in a secondary offering?
Good question. I would be thinking about sort of the following questions, right? What sectors do I understand? What do I know? What do I follow? What are the trends, right? What do I really like? What do I see the opportunities taking place, right? So for many of you, I'm sure you've seen all the headlines across plant-based, across crypto, blockchain, across impact sustainability opportunities, and obviously software. Another question I'll be asking is, do I want to own the stock in the company directly, right? Or be an LP in a fund, right? Each of them has their own pros and cons. So in a traditional, secondary, you own one stock in one company. Well, excuse me. You own stock in one company, right? Which is going to be ultimately easier to value and to track and easier to transact in the future. You'd effectively be able to choose whether you want to buy pref or common stock, which specific series you're most interested in, right? But you'd ultimately need to do your own research and diligence. On the private equity front, right, if we're talking about LP interest, right, that's a little bit of a different story, right? And there's sort of pros and cons there, but in that sort of arrangement, investors would effectively own LP interest in a fund, which ultimately covers not a single company, but multiple companies. And so with that said, you'd effectively need to have trust in the manager / the GP and effectively rely on them with their sector expertise to actually make those decisions, which opportunities they decide to pursue or not. A few other questions. Am I going to be directly on a cap table? Will I have access to management, right? Will I be in an SPV that's already directly sitting on a cap table, right? Or is this going to be an SPV in an SPV? Some companies are very difficult to buy direct shares in, particularly for smaller orders. And so, SPVs may be the only option, for those that are looking to get into a particular company, but can't quite meet the minimums. Sometimes it comes in a form of a 0-0 SPV, sometimes not. Sometimes there's fees attached to it, and those fees can vary. Going direct on the cap table also becomes increasingly difficult as the company creates more value, right, and achieves a high valuation, right? And the less investors that are on the cap table, the longer the company can ultimately stay private. If any of you remember the good old days of Facebook, Facebook was effectively forced into becoming public because they were sort of maxed out with the investors on a cap table, right? Now, still focusing on the topic of going direct, the minimum for those type of investments tend to hover at 5 to, let's say, 10 million through 50. So I'll give you a couple of examples. If you wanted to go directly on a cap table in, let's say, Impossible Foods, in order to achieve that, you would need to come in with, call it a 25 or maybe a $50 million check. Bowery Farming is another great example. Bowery Farming is a vertical farming company backed by Temasek Holdings, Google Ventures, Charles River Ventures, a bunch of celebrities, and sort of the who's who, such as Henry Kravis. So company that just raised, 300 million in equity that's being valued at $2 billion, right? If you wanted to go directly on a cap table, that would come with a, much higher ticket, given that the company is worth so much more, right? And so, this kind of takes me to the next point of, if you have the access to a C-suite or a large cap table investor, there may be some flexibility in sort of those minimums, but that sort of comes with, quote unquote, twist in the arm, right? To facilitate that trade at 5, or 10 million, which again is often a heavy undertaking if the company is worth, several $billion.
Very good. So what questions or diligence should the investor focus on for a secondary? What should they be looking at, and what questions should they be asking?
All great questions. I would be thinking about what does the price per share sort of translate to in valuation. What you will oftentimes see is a company raising, 20, 40, 50 million, $100 million that has, taken place 6 months ago. But that does not necessarily mean that that is the price per share you're going to be buying, right, on the secondary front. A good example of that is Impossible Foods. The last price round the company undertook was in the summer of last year, which valued the company at about $4.2 billion. Today, the stock trades in the private markets somewhere around, call it $10 billion. And so as the company progresses, right, and achieves higher revenue and ultimately achieves higher valuation and value, right, that price per share will obviously increase. I would also be asking, how does the price that you're considering buying the stock for compare, right, to the last price round? What are the commissions, right? Everybody wants to know what you're actually going to be, ultimately paying for the stock. What is the all-in cost to you? Is the markup reasonable? Are you okay paying a carry if it's not a direct transfer or the stock is not available in a 0-0 SPV? What kind of management fees exist, right? If you're buying into an SPV, is it a one-time management fee? Is it an ongoing management fee? So in companies like SpaceX, which are very, very difficult to access, it's very rare that you'll, and frankly, impossible to find access into SpaceX in a 0-0 vehicle. And so what you're most likely to see is a vehicle that charges, call it 10 to 20% carry, but because the name is so hard to get into, those that have been able to gain access will set up their own SPVs and charge additional carry on top. So all of a sudden, instead of paying 10% or 20% carry, now you're looking at 30 or more, which will ultimately eat into your returns. I would also be thinking about due diligence, right? What information do you have available? What kind of due diligence are you going to be able to do? Is there a recent investment deck? Is there financials? Is there access to management? Is the seller actually making himself available, for a call? And what information are they willing to share with you? All right. What else can I tell you? I would also be thinking about what share class you're buying, right? If you are buying into Series A stock, right, share class, while the company's latest funding round was a Series F, that Series F stock is going to have higher seniority, right, and preference over Series A stock, right? So that's another very important thing to notice. Are you buying common, right? Not something you would potentially want to pursue, right? Just given that it sits lower on the sort of the structure. But that's another question to ask. You also want to know who the seller is, right? Where's the stock actually coming from? Are you able to connect with that seller, right? And then more importantly, right, what information rights do you get, if any? This has been a sticking point for, I'd say, a lot of our, especially institutional investors that are looking to write, 10, 20, 30, 50, $100 million checks, right? If I'm coming in with such a big check, what access do I have to information? Typically, for a company that's worth, hundreds of millions of dollars or billions of dollars, access to information doesn't really come attached with the investment unless you are coming in with, you know, a 50 or $100 million check, right? And so to get the level of detail that someone like Fidelity Investments would receive, right, upon making the investment, or the likes of L Catterton or Google Ventures, right, for a smaller investor that's, you know, coming in for, you know, $1 million or a couple of million or a few $100,000 or, you know, $5 or $10 million, right, becomes, you know, someone insignificant in the grand scheme of things, given the company is worth so much more, right? And so I would not necessarily expect for you to get those information rights, right, unless you were coming in with, you know, that big of a check. I would also be thinking about, what does the exit plan look like? Is the company looking to go public via an IPO, a SPAC, a direct listing? Will the company still private forever, right? If the company stays private forever, then how do you get out, right? And that's sort of where the topic of secondaries come in, right? So some investors get in through a secondary, and they're ultimately able to exit through a secondary, right? I would also be thinking about who the underwriter would be, right? Who's actually taking the company public, and what steps have been taken for an IPO. So these are all the questions that I would be thinking about.
Great. So how does an investor determine the valuation and compare that to the current price being offered? What are the techniques you use to see if it's in the right range?
Another great question. So determining what the valuation is, determining what the right valuation is, and what you're buying in the stock becomes, again, difficult, because there is no, call it, you know, a liquid market, right? You can't go on, you know, E-Trade or TD Ameritrade or Robinhood and trade, you know, in private security stock, right? And so the way that I would be thinking about it is sort of looking at the price per share over the last round, right? What was announced, but, you know, keep in mind that it's what you're getting publicly is not always 100% accurate. We've seen this in, you know, cases of comparison between Beyond Meat and Impossible Foods. There's a recent article on Reuters that talks about the market share, where Beyond Meat is compared to Impossible, and Reuters claimed that Impossible Foods owns 4% of the market, which, you know, to my knowledge is inaccurate. We've seen cases where the company makes, you know, an announcement of a capital raise, where, you know, they quote no one number, but the reality is, you know, the company may have taken, you know, slightly less, right? So this is another thing to kind of keep in mind. Non-price rounds, right? If the company has undertaken a convertible round, it's very rare that, you know, you'll have access to the fully diluted shares outstanding, right? Which will obviously dilute the valuation of the company. And so that's another thing to keep in mind. Look at some of the comms that may be out there, right? Not from sort of the, excuse me, absolute return, absolute valuation, right? But what revenue multiple they've been able to achieve, right? And so, again, a good comparison point would be Beyond to Impossible, right? What else can I tell you? Yeah, I mean, it's hard. It's hard to really value the company in the secondary market, because, again, there is no liquidity, right, quote unquote, as you would in your you know, Facebooks and Amazons of the world, where you can go online and check the bid and the ask, and there's, you know, sort of the pricing. And so it sort of comes down to, again, speaking with individuals, brokers that are operating in the secondaries market, checking the likes of Shares Post and EquityZen, and ultimately having access to perhaps some cap table investors, and having relationships with them, you know, that may be willing to enable to shed some light. So that's, I guess, those are the questions.
Great. So where can an investor find access to secondaries? Where do you go looking for those, and where do you find them?
So as far as secondaries, where to find secondaries, I'd say there's a few places you can look. One is obviously the existing management team, right? If there's a relationship with someone from the C-suite, that's sort of the quickest way of sort of finding whether they're willing to transact, whether they're looking to sell a portion of their stake, right? So management teams, existing investors, online platforms such as, again, SharesPost and EquityZen that are effectively marketplaces for these type of securities, and guys like us at ARGO.
Great. A question from the audience, any pros or cons of using platforms like SharePost or EquityZen? Any experience with those?
Yeah, so there's definitely call it pros and cons, right? With companies like SharesPost and EquityZen, while you'll be able to locate certain names, you're not going to find every name, right? From my understanding, both of these platforms are typically offering common shares, so that's another con. If you're only interested in buying pref stock, it's unlikely that you'll be able to find them on those platforms, or even micro ventures. But if you're looking to take down relatively smaller blocks, those platforms are certainly a place where you want to look. For larger blocks, again, it becomes somewhat more difficult to get access, because they ultimately have to locate the seller, right? And whether that is someone from the C-suite, whether it's an existing institutional investor, they ultimately need to find the stock, and a lot of that is based on relationships, right? I've heard stories of brokers reaching out to certain institutional investors and asking for a specific name, and hearing no in response. No, we're not interested. We're not selling. And literally a week later, we'll learn from another source that there is a seller. The seller is that institutional investor who, institutional investor who initially said no to another broker, but ultimately said yes to someone else, right? So a lot of it is very much relationship driven, which again is sort of the reason to build these relationships, both with institutional investors as well as the C-suite, if you have access to them.
Previously, you mentioned that Facebook had to go public. Can you explain in more detail why they had to go public?
So this really has to do with the FINRA SEC regulations relative to how many investors one is allowed to have on the cap table before ultimately being forced to go public. And so that's one of the issues that Facebook encountered back in the day. And that's really been one of the catalysts behind why Facebook was ultimately forced, or pushed to go public.
And what regulation or regulatory is that?
That's a good question. I need to brush up on where you can find this, but this is certainly publicly available.
Okay, great. And so private companies can go infinitely, can have an infinite number of shareholders. Is that not true?
No, so there is a limit. There is a limit to how many cap table investors can be on the actual cap table, right? Which is, one of the reasons why issuers also have a preference for having investors, smaller investors, participate through an SPV vehicle, right? Which would effectively come in as one name on the cap table, but that SPV can have hundreds of investors in it. But as far as the issuer is concerned, right, there's only one line item, right? XYZ SPV.
Okay, great. That makes sense. And so my last question is, what's your opinion of online platforms offering secondaries in general? Overall, what do you think about them as a source of deal flow?
Again, I think they're great platforms if you don't particularly care about whether you're buying preferred or common shares. If you're not a large institutional investor, looking to take down a 50 or $100 million block, they're great. They've been doing this for quite some time, and I imagine they're going to do very, very well as companies continue staying private longer, right? And this new, call it, asset class becomes more of a thing. We've had interactions with several very, very large asset managers that understand the opportunities that exist across secondary transactions, but have had challenges in understanding whether what they're buying into is actually valued properly, right? How do you know if you're a Wellington, right, and you're buying a $50 million block? How do you know what you're paying is actually accurate? One of the sort of big disparities between what the investors want and what's available is access to information. And so there's been some new entrants to the market that are looking to solve that problem. So again, it really depends on what kind of an investor you identify as, what kind of checks you're looking to write, what kind of diligence you're looking to do. I mean, heck, for some investors, it's a matter of FOMO, right? You want to own SpaceX, right? It sort of becomes kind of a bragging right, where you can go to your friends and say, yeah, I'm an investor in SpaceX. I'm not going to ask you whether you invested in an SPV, but it certainly is a can be a point of discussion, over drinks or wine. So I hope that answers the question.
I think so. Well, we've come to the end of our questions. If you have any more, put them in the chat box briefly. With that, we're going to head and want to thank Misha for joining us today, and we'll be reaching out to see if you guys on the audience have any other questions you'd like to discuss offline with Misha about. For 10 Capital, we have another event next Tuesday, August 24th at 4 p.m. We have actually a investor tools discussion, how to manage deal flow using online tools. And then we have on September 7th at 11 a.m., we have Why SPACs Are Booming with Maggie Springer of Green Cow Venture Capital. We'll be sending you more notices about those, and want to thank you guys for coming out and appreciate your sharing your questions with us today. And with that, Misha, thank you for joining us.
Thanks, all. Appreciate the time, and I hope this was a learning experience for those that attended.
Got a lot of good feedback in the comments. And like I say, we'll be reaching out to everybody to make connections to carry the dialogue forward afterwards. We did promise a half hour, so we're going to stick to our time, so we don't have to tell our next call, sorry, they kept me over like we always get. But with that, guys, we want to thank you for joining us today, and we'll go ahead and close it out. Thanks so much.